There's a lot to learn when you look at the past, which is that a high rate environment forces each individual company to frankly just be better managed because there's less money.
2 years after Chamath Palihapitiya took SoFi public in a SPAC merger, SoFi's stock price is up 111% year to date, making it by far the best performing stock he took public. And in my opinion, its upward sprint is far from over, because as I'll show you in this video, SoFi has finally reached a position where they could 20 or even 50x in price as they beat out the competition amid a super competitive fintech market with still sky-high Fed rates. So in this video, I'll be going over why SoFi is different from both Chamath's, other SPACs, and even other fintechs in the market today, like Robinhood. And I'll be doing it in 3 ways: showing SoFi's hidden potential in their business model, proving SoFi has the leadership to carry the ship forward, and talking through SoFi's just released earnings numbers to back that story up. So by the end of this video, you'll know exactly why I personally have $18,000 invested in this stock. So SoFi is a fintech business, but that doesn't really describe what they do. They're really 3 businesses in one, and I think it's kind of easiest to understand them like a funnel. At the top of the funnel, you have SoFi's financial services segment, which basically includes everything they offer in their mobile app: SoFi Money, SoFi Invest, and SoFi Relay for tracking your money. All these customers are then funneled into SoFi Lending. This is the slowest growing but most profitable part of the business, bringing in around 2/3 of SoFi's revenue at a 25% year-over-year growth rate. Then underlying the whole business is the technology platform, which was created when they purchased Galileo Technology Platform in 2020 for $1.2 billion. At the time, that was worth just 10% of SoFi's market cap, but I think the tech platform is now much more valuable than anyone realizes, giving them the potential to run other fintech businesses on top of their tech stack. Robinhood is just one customer as an example. But let's walk through how this unique triple threat business model makes SoFi the best fintech play in the market. So to understand why SoFi is my single largest fintech investment, we need to look at how the company's products put them ahead of the competition. And to do that, we're going to be using a SWOT analysis, which is taken from my ebook. And a SWOT analysis is just a fancy way of saying we'll be looking at the reasons why SoFi is going to win. So we'll be doing this in 4 pieces. First, looking at SoFi's internal strengths and weaknesses, and then looking outside the company at the huge opportunities in front of them, as well as some very dangerous threats to their business in the marketplace. Starting with strengths, what is SoFi's special sauce, and how will that help them increase their stock price in the future? Well, the first strength is SoFi's lending business, which actually grew out of their original student loan business the company was first founded on at Stanford Business School. This is a cash cow for SoFi, bringing in over $300 million of the company's total $489 million in revenue this quarter. Even after the moratorium on student loans starting in 2020, which tanked the student loan market, SoFi was still able to succeed by pivoting into other loan types, which is also our second strength for SoFi. They dominate the private student loan market. Before the shutdowns, they owned as much as 70% of the entire private student loan market in the US. And now that student loan market is likely going to come back, with federal borrowers potentially refinancing to cheaper private loans. And that's a big chance for SoFi to make some serious money. It's like the pandemic dug a hole out of SoFi's earnings, they filled in the hole with personal loans, and now with student loans coming back, they'll just have a mountain of extra cash piling up. And cash means options. Options mean success. Success means more money for investors. And that rapid pivot SoFi made to filling in the hole left by student loans leads us to the third strength that SoFi shows. They have an incredibly strong leadership team. The company's CEO is like the superhero of CEOs. He was the chief operating officer of Twitter, a tech company. He was the chief financial officer of the NFL and a managing partner at Goldman Sachs, both finance opportunities. And now Anthony Noto can bring that knowledge to bear as the CEO of SoFi, a company that's competing with the best in the tech and finance spaces at the same time. Which also leads us into our last 2 strengths SoFi shows. They have an ecosystem of products and they're vertically integrating. SoFi is kind of like Apple. They make products that work better together. If you sign up for a SoFi credit card, you can earn points by setting up direct deposit with their bank account. SoFi Relay can help you budget and also scan your bank account to see if maybe you have some high interest debt you should refinance into a personal loan. And since SoFi is a national bank and they run their own technology platform, they're more efficient than their competitors. In fact, they're so efficient that some of their competitors are now running using SoFi's products under the surface, with huge clients like Toast, Robinhood, and H&R Block using their platform to enable their own banking or credit card or payments products. That's just rubbing salt in the wound. But no company is perfect. perfect, and if they were, I'd be too skeptical to invest anyway. So now let's look at a potentially even more important part of the company for investors, SoFi's weaknesses. Since this is where we need to watch super closely to avoid getting burned by an unexpected drop in the stock price. From the beginning, most of Chamath Palihapitiya's SPACs have lost money, and I don't just mean in the stock price, because boy have their stock prices lost money, but also none of them have made a profit. SoFi, for example, has lost money every quarter that they've been public in terms of net profit. Now, if we subtract out some GAAP expenses like stock-based compensation, the picture looks a little more rosy, with the company reporting adjusted EBITDA of $77 million this quarter, which basically just represents the profit the business itself is making, ignoring taxes, depreciation, stock dilution, etc. So there is hope for the future. But then there's the other side of that coin, in that SoFi still has stock-based compensation that's very high for a bank. Stock-based compensation is where you pay employees or leadership by giving them shares of stock rather than paying them in cash. This is good because the more stock employees have, the more they want the company to succeed, but it can get out of hand. With SoFi spending 24% of their revenue on stock-based compensation in 2022, many felt it was out of hand and was diluting the value of the stock price. But it's since dropped to 16% and then 14% in their most recent quarter, so it's following a good trend. And part of the reason that's dropped as a percentage of revenue is SoFi is making more money with the higher interest rates that we're seeing. And while that sounds like a good thing, it also points to another weakness. SoFi has huge exposure to the financial markets. It's true, a bank has exposure to finance. It might sound ridiculous, but it's worth calling out since I'm mostly a tech investor, and SoFi is much more affected by the larger economy than tech. They're affected by swings in the banking market, small banks going out of business, and every whim of the Fed much more than other stocks. And that is then tied to SoFi's last weakness, the student loan pause. While we've already said that an ending to the student loan moratorium would bring business back to SoFi, the fact that SoFi needs to rely on the government to end the pause shows a weakness in their business, if a relatively minor one. Other companies haven't been as affected because most other fintechs aren't as concentrated in student loans as SoFi is. I do think Noto is doing well to address this by diversifying their portfolio into personal loans, mortgages, and even car loans through a partner, but it's still worth calling out. So the strengths and weaknesses mainly focus on what's happening inside SoFi, which is important. But let's now turn our sights to what's happening in the market around SoFi, since these could have an even bigger impact on the stock price. Starting with one of the biggest opportunities SoFi or any fintech has ever seen to revolutionize financial markets. And that first opportunity is for SoFi to become the AWS of fintech. Ever since acquiring both the Galileo Technology Platform in 2020 and Technisys in 2022, they've been building up a technology layer below their business that runs the rest of the business on top of it. This is exactly the same strategy that Amazon used back in the day when they were building technology to support their massive online store, which they then leased out to others. That business became AWS, the largest of the cloud providers and a $20 billion a year business all on its own, producing a third of Amazon's yearly profit. SoFi has the opportunity to do the same thing with fintech, creating the building blocks that other companies can use in their businesses. Want to launch a credit card, a bank account, or a lending product? Just run it on top of SoFi's technology platform. This segment alone could easily be worth more than SoFi's entire market cap today. And Chamath says that today, while interest rates are high and the stock price is down, is the best time for SoFi to prove themselves.
We've actually counterintuitively built better businesses during periods of high rates. It forces each individual company to frankly just be better managed because there's less money.
So seeing SoFi winning and becoming more profitable during hard times bodes extremely well for the good times. And this focus on great technology enables SoFi's next opportunity that drives their entire mission, winning customers from legacy banks. SoFi estimates there are 500 million legacy bank accounts, with nearly 50% of those held by just 10 banks. This offers a huge runway of customers that they can win from the legacy banks by offering better interest rates on bank accounts, better services on their app, and just an overall better customer experience for millennials and Gen Z especially, who, by the way, will be holding a lot more money in the future than they are today, money they'll hold with SoFi. But those are longer term opportunities. What chances does SoFi have to make money and increase their stock price this year and in the near future? Well, the third and fourth opportunities are tied together. Now that SoFi has complete vertical integration by obtaining a bank charter, they can hold users' money in their own accounts and take out loans against that money. I won't get into crazy detail here, but basically that means SoFi has a source of incredibly cheap money they can use to grow the business without taking on more risk, without diluting the stock price, and without alienating customers by charging more for existing features. So that's it. SoFi is the perfect investment. Well, hold on. We've looked at the opportunities, but now we need to look at the looming threats in the market, some of which could literally destroy SoFi's business overnight if they went wrong. And now let's get to the threats in the market that could threaten SoFi's both short-term and long-term stock price. The first threat is SoFi's lending segments in the incredibly tumultuous macroeconomic environment we're currently seeing. SoFi survived one potentially company-ending calamity when Noto pulled them out of student loans and into personal loans. But if there was a larger collapse in lending like we saw in 2008 with the Great Recession, even Noto might not be able to save the company. So I guess we'll still need to tune in to the Fed chairman's latest sermons. Now that's a pretty unlikely threat, so here's one that is actually happening right now. A larger competitor could come and copy SoFi's business and steal all their customers. You might think of most banks as old and outdated, but we've seen companies like JP Morgan Chase release features that rival some of SoFi's, and even Goldman Sachs has gotten into the game, launching a high-yield savings account called Marcus and partnering with the biggest tech company in the world to launch a credit card. SoFi's now doing such a good job beating back companies that are around their own size that it's possible the big players will soon take notice and try to fight back. And if that happens, it'll be a fight for SoFi's life. But I guess that's the price of success. But the biggest threat of all is one we've seen bring down multiple fintech companies in just the last few years, even putting a huge dent in Robinhood's stock price, as they've lost nearly 70% of their value since they went public. And that is the threat of something happening to their brand as a fintech. Fintech brands are incredibly valuable. People need to trust the companies with their money after all. And that's why SoFi's made flashy marketing moves like SoFi Stadium or the SoFi Money Moves campaign. They are investing in their brand. But if they make one wrong move, that could all go away overnight. Look what happened to Robinhood when they made some potentially shady moves around GameStop, or Lending Club after they were sued by the FTC, formerly rocket ship companies that seemed unstoppable that have mostly floundered ever since. So when we put it all together, we can use this SWOT analysis to see if SoFi seems like a good opportunity to invest. And since I'm already investing $18,000 in the stock, you know my answer, so tell me yours in the comments. Don't forget to subscribe for more stock breakdowns, and I'll see you next time.